The U.S. housing industry just lost $50 billion. Last week, the CEO of Home Depot verified it on live television. Additionally, he issued the same caution when he described the housing market as frozen on the same earnings call. The CEO of Lowe's released the following day. Both of these businesses last issued a warning about this alignment in 2008. Not 2008, not 2020, nor 2022. Additionally, both businesses recently reduced their 2026 projections below Wall Street's expectations. Lowe's stock dropped 5% in a single session because of it. 3 things we're going to prove to you in this video. 1. Where that $50 billion actually went, and why it's been deliberately kept out of the headlines. 2. The single piece of housing data that hasn't been this low since 1995, and why that specifically means your home equity is not what you think it is. And 3. The 3 exact triggers the CEO of Home Depot admitted he's watching for. Because when those flip, this frozen market breaks fast. And we mean fast. Home Depot reported their 4th quarter and full year 2025 results on February 24, 2026. On paper, they had a fine quarter. Sales came in at $38.2 billion. Same-store sales technically positive. The stock even popped on the news. That's the story Wall Street wanted you to read. But the story buried in the earnings call transcript, the one most retail investors never hear, is a completely different video. CEO Ted Decker came out and said, and I'm reading this directly from the call, that housing turnover has likely reached the bottom at about 3% of homes changing hands per year. And he said they are not expecting a big rebound nor significant increases in new housing starts anytime soon. So that's the #1 guy at the largest home improvement retailer in America, telling us he sees no rebound coming. Then his CFO, Richard McPhail, went on CNBC the same day and said, and again this is a direct quote, "We've been in a frozen housing environment for 3 years, and there hasn't been a meaningful thaw." Now, think about that for a second. The Federal Reserve has cut rates. Mortgage rates have come down. We've had a so-called housing recovery talked about in the news for 2 years. And the CFO of Home Depot is saying none of that has actually thawed the market in any way that shows up in their business. And then Decker said the quiet part out loud. He said, American homeowners have collectively underspent $50 billion on home improvement projects over the last 3 years. Let me say that again because I want to make sure you heard me. $50 billion. Not projected, not estimated, gone, already missing from the U.S. economy. Evaporated from kitchens that didn't get renovated, bathrooms that didn't get replaced, appliances that still have duct tape on them. That money was supposed to be spent. It wasn't, and nobody outside of this earnings call is telling you that. Big-ticket transactions over $1,000 at Home Depot were up just 1.3%. And that's largely because of inflation, not actual demand. Comp transactions, meaning the actual number of customers walking in the door, were down 1.6%. Fewer people, smaller projects, cheaper purchases. Decker called it more repair than replace, meaning Americans are patching what's broken and praying the rest holds together for another year. And the part that should really get your attention is what Home Depot guided for 2026. Comparable sales growth of 0 to 2% for the entire year. Operating margins compressing. Earnings per share growth of 0 to 4%. This is a company that historically grows in the high single digits. And they are basically telling Wall Street 2026 is going to look just like 2025. Flat, frozen, going nowhere. That's the CEO of America's largest home improvement retailer looking Wall Street in the eye and saying 2026 is already over. And here's the part that should genuinely scare you, because it isn't just Home Depot. 24 hours later, the CEO of Lowe's got on his own earnings call and said something that, if you understand what it actually means, is even worse. Lowe's reported their fourth quarter results on February 25, 2026, literally one business day after Home Depot. And both companies on back-to-back days used almost identical language to describe the housing market. Same diagnosis, same prognosis, same warnings about 2026. Lowe's CEO Marvin Ellison came right out and said, and this is a direct quote from the press release, "While the housing macro remains pressured, we're focused on directing what is within our control." On the call, he went further. He said their outlook for 2026 is, quote, cautious, given the persistent volatility in the housing macro, and that this uncertainty continues to pressure big-ticket discretionary projects as many consumers are reluctant to make significant investment in their homes. Sound familiar? It's the exact same story Home Depot just told. And then Ellison said one sentence that explains this entire video. Here it is. Direct quote. "The greatest fuel for the home improvement industry is when you decide to put your house on the market. Because the first thing you do when you put it on the market is you fix up your yard, you repair your fence, you paint your walls, you do simple beautification modifications in your home." Read that quote again because it explains everything. Home Depot and Lowe's are real-time leading indicators for the housing market because their entire business depends on people moving. When nobody is selling their house, nobody fixes it up to put on the market. And nobody who buys a house fixes up the new place either because nobody is buying. That's the chain reaction that has both of these massive companies sounding alarms at the same time. And Wall Street took it dead seriously. Lowe's beat their fourth quarter earnings expectations. They actually had a good quarter, but their 2026 guidance came in below what analysts were looking for. Wall Street wanted adjusted earnings per share of about $12.95. Lowe's guided $12.25 to $12.75. The stock dropped about 5% in a single session. Lowe's CFO Brandon Sink said point-blank that they're seeing, quote, deferral of big-ticket spend, which we've been experiencing now for a number of years. Years, not months. Years. Quick pause. If you're getting value out of this breakdown so far, hit that subscribe button so you don't miss the next one. We track these earnings calls in real time every quarter, and something is developing fast right now. All right, back to it. So, the question is why? Why is this happening right now? Here's the number we told you we'd come back to. Existing home sales in 2025, 4.06 million homes for the entire year. You have to go back to 1995 to find a year that was this slow. Think about that. Bill Clinton was in his first term. The internet was still dial-up. That's the last time this few Americans bought a home in a single year. And then, in March 2026, the most recent data we have, sales fell another 3.6% month-over-month to an annual pace of 3.98 million homes, the slowest March pace since 2009. Here's what's even crazier. The home turnover rate, meaning the percentage of all U.S. homes that actually changed hands in a given year, was 2.77% in 2025. That's the lowest in at least 30 years. The historical norm is around 4%, so we're about 30% below the normal level of housing activity, and we've been there for 3 straight years. That's what Home Depot's CFO meant when he called this duration unprecedented in 50 years. We have literally never had a period this long, this slow in the modern history of the U.S. housing market. And the cause of all this is one phrase: the lock-in effect. The most recent FHFA data shows 51.5% of all outstanding mortgages in the country are locked in below 4%. About 78.8% are below 6%. Meanwhile, the current 30-year mortgage rate is hovering around 6.3%. Let me make this real for you. You bought a $400,000 home in 2021 at 3.5%. Your principal and interest is about $1,800 a month. Today, you sell that house and buy one at the exact same price. Your new payment almost $2,500. Same house, same price, $700 more every single month. That's $8,400 a year out of your pocket for the privilege of moving sideways. That's why nobody's selling. It's not stubbornness, it's math. A Bankrate survey from last year found that 54% of homeowners said no mortgage rate would make them comfortable selling in 2025. That's not 54% saying they need a lower rate. That's 54% saying there is literally no rate that would get them to move. They are stuck. And as long as they're stuck, inventory stays low. Buyers can't find homes they can afford, and the whole thing grinds to a halt. Here's who's winning and losing in this frozen market right now ranked. If you're a buyer with cash or a strong pre-approval, you have more power than you've had in 5 years. 18.3% of listings on Redfin cut prices in March. Days on market are up to 55. Sellers aren't breaking. Use that leverage or don't. But it's there. If you're a seller, the brutal truth is the median list price on Realtor.com has been declining year over year for 5 straight months, and you're competing against homes that have been sitting for months. Price realistically or don't list it. There is no third option. And if you're a homeowner who isn't moving, congratulations. You're in the single luckiest group of American homeowners in 50 years. You're locked into a mortgage you will never qualify for again. Don't ever give up lightly. Here's what makes the Home Depot and Lowe's warnings really concerning to us. They're not happening in isolation. The entire housing ecosystem is flashing red right now, and we want to walk you through 3 different layers of confirmation because each one tells a piece of the story. Start with the home builders because they have the most skin in the game. KB Home just cut their 2026 revenue guidance from a previous high of $6.1 billion, all the way down to $4.8 to $5.5 billion. That is a massive cut. Their CEO admitted that orders in the first quarter were below the level they needed. Len just reported that their incentives, the discounts and freebies and rate buydowns they have to offer to actually move homes are now running at about 14% of the home price. Their executive chairman, Stuart Miller, called this their circuit breaker because the historical normalized level for incentives is about 5 to 6%. They're running at more than double the normal level just to find buyers. And D.R. Horton, the largest home builder in America by volume, just disclosed that 73% of their buyers in the most recent quarter received some form of mortgage rate buydown to be able to afford the home. Their advertising rates as low as 4.99% and in some cases 3.99% on temporary buys just to get people in the door. And that's just the builders. Wait until you see what the data underneath them is doing. Now, zoom out one level to builder sentiment overall. The NAHB Housing Market Index just printed at 34 in April 2026. That's the 24th consecutive month it's been below 50. Anything below 50 means more builders see conditions as poor than good. The buyer traffic component of that index came in at just 22, which is less than half of the threshold for a healthy market. Completed but unsold new homes sitting on the ground right now stand at about 122,000 units. That is the most since July 2009. Read that again. the most unsold new homes since July 2009. This is the inventory that builders thought they could sell, and they can't move it. But the builders aren't even the scariest part of this. The mortgage data is. Here's the part the mainstream housing media won't touch. The latest Intercontinental Exchange mortgage technology data shows the foreclosure pre-sale inventory is up nearly 25% year over year. There are now 878,000 loans that are 90 days or more past due or in active foreclosure. That is the largest such volume since July 2022. Most concerning FHA loans typically used by first-time and lower-income buyers account for over 80% of the recent rise in serious delinquencies. And FHA seriously delinquent volumes are up over 40%. Adam Data Solutions reported that foreclosure filings in the first quarter of 2026 were up 26% year over year. Bank repossessions specifically were up 45%. Totality, which used to be CoreLogic, reported that 13 states plus D.C. are now showing year-over-year price declines, with Florida, D.C., and Montana leading the drops. So, when you put all of this together, the builder distress, the NAHB readings, the foreclosure data, the Home Depot warnings, the Lowe's warnings, there's one thing nobody in mainstream housing media will say out loud. So, I'm going to say it, and it's going to piss some people off in the comments, I know, but let me know what you think. Agree? Disagree? I want to hear it. Here it is. The Federal Reserve is not going to save this market. The headlines keep telling you that when the Fed cuts, housing recovers. That's not what's happening. The Fed has already cut rates. Mortgage rates have already come down from the peak, and nothing has thawed, because the problem isn't the Fed. The problem is that half of American homeowners are locked into a mortgage the Fed can't touch, and they're not selling. Not this year, not next year, probably not for 5 years. So, if you're waiting for Jerome Powell to fix the housing market for you, stop waiting. He can't. Hit the like button if you want us to keep being this direct in these breakdowns. That's what tells the algorithm to show this to more people who need to hear it. Now, some of you are watching this and thinking, this sounds like 2008 all over again. So, let me be honest with you, because that is not exactly what's happening. And the differences matter. In 2008, we had over 4% of all mortgages in active foreclosure. Today, that number is 0.48%. In 2008, mortgage delinquencies were running around 12%. Today, 3.72%. In 2008, about 26% of all homes had negative equity, meaning the homeowner owed more than the house was worth. Today, that number is closer to 1.6 to 2.2%. So, no, by the strict definition of a 2008-style crash, that is not what we're in right now. The consumer balance sheet is actually, as Home Depot's CFO put it, better than pre-COVID for most homeowners. But here's what we think is actually more important to understand. What we are in right now is something we have arguably never been in before in the modern era. We're in a multi-year structural stagnation that is starting to crack at the edges. FHA borrowers are falling behind. Florida and Texas are seeing real price declines. New home construction is sitting unsold at the highest level in 16 years. Builders are giving away the store just to move product. And the two largest home improvement retailers in America just told Wall Street they expect this to continue through all of 2026. Even Jamie Dimon, the CEO of J.P. Morgan, said on his most recent earnings call last week that he believes the next credit cycle is going to be, quote, worse than people expect. And he said credit quality has already begun to erode. So now this isn't 2008. It's something nobody has a name for yet. A market where the crash never comes, but it never recovers either. Where the freeze just keeps deepening until something finally snaps. And I'll tell you what, we think snaps first, right after this. I'm going to walk you through 3 triggers in reverse order, worst to most immediate. Because trigger number 1, the last one I cover, is the one I want you to really remember. That's the one I'm actually watching. Let's start with the worst-case scenario. Trigger 3 is the one I think is furthest away in time, but would be the worst if it hits. Ted Decker called this the downside scenario on the earnings call. He said, if we start to see widespread home price decreases, that could create a, quote, negative psychological impact, where turnover stays low, but pricing finally cracks. In plain English, if homeowners start believing their home value is actually going down, they may try to sell before it goes down further, which floods the market with inventory at exactly the moment buyers are most reluctant. That's the scenario that could turn the slow freeze into something much faster and much uglier. And we're already starting to see early signs of this in 13 states with year-over-year price declines. That's the ticking bomb. Trigger 2 is the one everybody is talking about, a sustained break in mortgage rates below 6%. Lowe's CFO specifically said, and I quote, "We do look at sub-6% rates as potentially stimulating demand." The 30-year mortgage rate did briefly dip to 5.99% back in early January 2026, but it has bounced back up to about 6.3% since then. And here's the thing about Trigger 2 that most people miss. Even if rates do break below 6% for real, they don't stay there unless inflation stays tame. And inflation right now is a little sticky. The CEO of the NAHB just said, publicly, he does not expect mortgage rates to consistently get into the mid to high 5s until early 2027. So, the scenario most viewers are betting on, the Fed keeps cutting, rates break 6%, the market unlocks, is the one the builders themselves don't believe in. Let that sink in. And now, trigger number 1, the closest one, the one we think actually matters most to the people watching this video. Big-ticket transactions at Home Depot and Lowe's. Decker said specifically, "We've not seen the increase in big-ticket, and that will be a telltale for a turn in the market." What that means in English, when appliances, kitchen remodels, and full bathroom renovations start moving again at these 2 stores. That's the canary in the coal mine, telling you the American consumer is finally confident enough to spend. Right now, none of that is happening. But it could flip quickly, and when it does, it'll show up in a Home Depot earnings call before it ever shows up in a Wall Street Journal headline. That's the one we're watching. And that's the one you should be watching too. Here's what we want you to remember from this whole video. The 2 biggest home improvement retailers in America just told Wall Street that nothing changes in 2026. Not the freeze, not the turnover, not the $50 billion hole in their industry. This is not a crash. This is something worse. This is a market so locked up that even when the Fed cuts rates and mortgage rates come down, the volume doesn't move because the people who would be selling won't sell. And until one of those 3 triggers flips, you're watching the slowest motion real estate event in modern American history. Now, I told you earlier Florida and Texas were seeing real price declines.